Pfizer Incorporated is one of the largest and most established pharmaceutical companies in the world. It develops, manufactures, and sells medicines and vaccines across nearly every major therapeutic area, from infectious disease and oncology to cardiovascular and immunology. Over the last few years, Pfizer's identity was largely tied to the pandemic, when its COVID vaccine and antiviral pill generated record revenues. But now, as pandemic demand fades, the company is in the middle of a major transition back to its core business and toward new areas of growth. Pfizer's latest financial report from the third quarter of 2025 paints a picture of a company finding its balance again after the historic COVID boom. During that quarter, Pfizer generated roughly $16.7 billion in revenue. That represented a decline of around 7% compared with the same quarter a year earlier. The reason for that drop is simple. The demand for COVID-related products, both the vaccine and the antiviral, has continued to normalize as the world moves beyond the emergency phase of the pandemic. However, it wasn't all negative news. If we remove the COVID products from the mix, Pfizer's other businesses actually grew by around 4% on an operational basis. That growth came from several areas, including oncology, cardiovascular treatments, and specialty care drugs. It shows that even without the COVID tailwind, Pfizer still has a solid foundation of recurring revenue from its broad drug portfolio. Earnings for the quarter were stronger than expected. Reported earnings per share came in at roughly 62 cents, and adjusted earnings per share, which exclude one-time charges, were around 87 cents. That was slightly ahead of what analysts had predicted. For the full year 2025, Pfizer reaffirmed its outlook, expecting total revenue somewhere between $61 billion and $64 billion. The company also raised its forecast for adjusted earnings per share to a range between $3 and $3.15. These numbers suggest that Pfizer's management believes the company has stabilized and can maintain profitability even as COVID revenue falls. It also indicates that cost-cutting and efficiency programs are starting to take effect. Pfizer has been very vocal about its multi-billion-dollar cost reduction plan, which is expected to boost margins and free up capital for new investments. Beneath the surface, Pfizer is reshaping itself for the post-pandemic world. The decline in COVID sales is the obvious headwind, but it's also an opportunity to reallocate resources toward growth areas. The company is putting more effort into developing obesity treatments, cancer drugs, and next-generation vaccines. It has announced several acquisitions and licensing deals in these categories to strengthen its research pipeline. These strategic moves show Pfizer is trying to use its pandemic windfall to fund the next phase of innovation. On the financial side, Pfizer continues to generate strong cash flow and maintains a healthy balance sheet. Its size and global scale give it flexibility that smaller biotech firms don't have. Even in a challenging environment, Pfizer still produces tens of billions in revenue annually, pays a reliable dividend, and retains an investment-grade credit rating. The company has also taken steps to streamline operations, reduce redundancies, and improve manufacturing efficiency. From an investment perspective, the bullish case for Pfizer centers on three key ideas. First, the company's earnings and dividend stability make it appealing for long-term, income-focused investors. Second, its vast product portfolio and global reach provide resilience even in slow growth periods. And third, the success of its pipeline in high-growth areas like obesity and oncology could re-accelerate growth over the next few years. However, there are clear risks investors must consider. The most obvious one is the continued drop in COVID product revenues. Those products generated enormous cash flow, and replacing that level of income will take time. Another concern is competition. The pharmaceutical industry is fiercely competitive, with rivals constantly developing similar or better drugs. Pfizer also faces the constant challenge of patent expirations and generic competition, which can erode margins on older drugs. There are also regulatory and political risks. Changes in government policy on drug pricing, manufacturing incentives, or approval processes could impact Pfizer's profitability. And like all large pharmaceutical companies, Pfizer must continually invest billions of dollars in research and development just to maintain its market position. If those investments fail to produce successful new drugs, the company's growth could slow further. So, what does this mean for investors right now? Pfizer should be viewed as a stable defensive play in the healthcare sector rather than a high-growth stock. For investors seeking steady dividends, moderate growth, and exposure to the pharmaceutical industry, Pfizer offers a relatively safe option. But for those chasing rapid gains, it might not be the right fit. The company is large, mature, and less likely to deliver explosive returns compared with smaller biotech firms. The key metrics to watch going forward include how quickly Pfizer can grow its non-COVID revenue stream, whether cost-saving programs actually improve margins, and how its new drug launches perform in the market. The pipeline will determine Pfizer's future more than anything else. Success in obesity treatments or next-generation vaccines could reinvigorate the stock, but continued sluggishness or regulatory setbacks could keep the share price under pressure. Pfizer's management seems confident in the transition plan. They've reaffirmed guidance, continued shareholder returns, and positioned the company for gradual improvement. The market, however, remains skeptical, which is why the stock trades near multi-year lows, hovering in the mid-20s per share. That could make it attractive for value investors who believe Pfizer will successfully execute its turnaround over the next 2 to 3 years. In short, Pfizer today is a company in reset mode, moving from the highs of the pandemic boom to a more balanced, steady growth pharmaceutical business. It still generates more than $60 billion a year in revenue. It's profitable, and it continues to invest heavily in innovation. It may not be the most exciting stock in the market, but it's a pillar of stability in an uncertain world. For patient investors, that stability, combined with a generous dividend and a credible cost savings plan, could make Pfizer an appealing long-term hold.